Every financial headline screams rationality. Yet beneath the surface, Wall Street often behaves like a roaring crowd. You're told prices reflect intrinsic value, but Benjamin Graham showed us the truth. The market is a fickle voting machine of sentiment, not a precise weighing machine of worth. Ignore this paradox that emotion, not logic, frequently dictates swings, and you invite costly mistakes into your portfolio. True investment wisdom begins by understanding this fundamental irrationality. 1. Intrinsic value and the margin of safety. Welcome back to Audiobook Bites, where we distill timeless wisdom for today's discerning listeners. Today, we're diving deep into the bedrock of value investing, a concept so fundamental it's almost a moral imperative. Benjamin Graham and David Dodd's insights on intrinsic value and the margin of safety. Graham and Dodd, the titans of fundamental analysis, didn't want you to chase fleeting trends or get caught in the market's emotional tides. They taught that true value isn't found in a flashy ticker, but deep within the company itself. Intrinsic value, they famously wrote, is that value which is justified by the facts, e.g. the assets, earnings, dividends, definite prospects, as distinct, let us say, from market quotations established by artificial manipulation or distorted by psychological excesses. Here's the crucial distinction. They saw the market not as an infallible oracle, but as a fickle friend, sometimes a manic voting machine swayed by emotion, sometimes a sober weighing machine reflecting true worth. This intuitive understanding, often lost in today's frenetic trading, means that prices are rarely perfectly aligned with what a business is truly worth. This brings us to their paramount concept, your ultimate defense in an unpredictable financial world. The margin of safety. Imagine you're building a bridge. You calculate it needs to hold, say, 10 tons. A responsible engineer wouldn't design it to just 10 tons. They'd build it for 15, maybe 20 tons to account for unforeseen stresses, bad weather, or just human error. That extra capacity, that's your margin of safety. In investing, it's buying something for far less than its true, demonstrable worth. As Graham and Dodd put it, precision is in any case unnecessary because the aim is to pay a good deal less than intrinsic value, so as to provide a margin of safety. Many investors today get lured by hot trends and soaring prices, but Graham and Dodd warned against this siren song. Therefore, you must anchor your decisions in verifiable facts, not speculative enthusiasm. First, always evaluate potential investments based on their underlying facts, their assets, their proven earnings, their dividends, and not just the latest price trend. Forget what the talking heads on financial TV are saying. Look at what the business actually does and has done. Second, calculate a potential margin of safety for every asset you consider. Don't just accept a company's projected growth as gospel. Dig into the numbers. What are the tangible assets? What are the consistent earnings, not just the recent spikes? If a company's stock is trading at a price barely above your rigorously calculated intrinsic value, where's your buffer against error or bad luck? Third, resist the urge to buy at full value, even for seemingly good companies. A great business can still be a bad investment if you pay too much for it. Don't be afraid to walk away if the price doesn't offer that protective cushion. The goal isn't to be right all the time. It's to ensure that when you are wrong, your capital isn't wiped out. Imagine waking up tomorrow to a sudden market downturn, a financial crisis that sends prices tumbling. Those who bought with a solid margin of safety will weather the storm, perhaps even finding new opportunities. But those who chased fleeting trends, who paid full price for a whisper of future growth, will find their capital exposed, vulnerable. The bottom line asterisk, as Graham and Dodd famously stated, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. This isn't just theory. It's your blueprint for enduring wealth. 2. A timeless delineation. Benjamin Graham and David Dodd laid down a bedrock principle, a distinction so vital, so often misunderstood, it remains their most powerful legacy. They drew a clear line in the sand between investment and speculation. You might think this is just semantics, but misunderstanding it has led countless fortunes to ruin. For Graham and Dodd, true investment isn't a gamble. It's methodical. As they put it, and this is crucial, An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Think about that. Thorough analysis, safety of principal, satisfactory return. If your current holdings or potential purchases don't meet all three of these stringent requirements, they don't qualify as investments. They are, by definition, speculation. So where do your own decisions fall? Are you chasing the quick profit, hoping for a stock price to soar based on a hot tip or a fleeting trend? That's the realm of speculation. Perhaps you're buying a company because it's a great story, or everyone else is piling in. Here's the catch, your motive matters. Long-term safety and a predictable return require relentless diligence. Quick profits, however alluring, often hide a trap. Graham and Dodd consistently warned against operations that lacked a clear analytical basis for principal safety. They saw it as inviting financial calamity. You might be thinking, but I buy good companies. Yet, even the best companies can become speculative if the price you pay isn't justified by a rigorous analysis of its underlying value. Ignoring these fundamental principles, as history repeatedly shows, inevitably leads to pain. Consider the dot-com bubble or the subprime mortgage crisis. Both were fueled by new era theories that utterly ignored intrinsic value, mistaking fleeting popularity for permanent worth. The consequences were devastating. Graham and Dodd famously understood that the market isn't always rational. They taught us to view it not as a precise weighing machine, diligently assessing value, but rather as a voting machine, whereon countless individuals register choices which are the product partly of reason and partly of emotion. This powerful image reminds us that market prices can be distorted by greed, fear, and fleeting sentiment, creating both rampant overvaluations and profoundly undervalued opportunities. The bottom line, true investment success isn't about predicting the next hot trend or blindly following the herd. It's about a disciplined, analytical approach rooted in verifiable facts that always prioritizes the safety of your capital and a satisfactory return above all else. 3. Beyond headline earnings, the income statement. It seems like the most straightforward financial document, doesn't it? The grand tally of a company's performance, telling you exactly what it earned. But Graham and Dodd teach us that this seemingly simple ledger can be a masterclass in misdirection, a canvas for misleading artifices that can fool even the savviest observer. Imagine waking up tomorrow to find the earnings per share figure for your favorite company has skyrocketed. A quick celebration, perhaps, but a discerning investor would immediately ask, why? Graham and Dodd warn that managements often inflate these numbers by including non-recurrent profits. Think of a company selling off a rarely used factory or winning a one-time legal settlement. These cash inflows, while real, are extraordinary, not part of the ordinary business. Yet, they can be folded into headline earnings, painting a picture of robust performance that isn't sustainable and certainly not indicative of true earning power. This creates a dangerous illusion, masking the consistent, ordinary operations that genuinely drive a business's health. You see the big, impressive number, but you're not seeing the magic trick behind it. But it gets worse. Sometimes these accounting artifices are designed not just to include one-time gains, but to deliberately obscure losses. By shifting charges, perhaps inventory write-downs or development expenses, from the current income account directly to surplus, management makes current profits look far healthier than they are. It's like clearing clutter from the living room by shoving it into the closet. The house looks tidy, but the mess still exists. And remember, the motivations behind such practices can range from innocent attempts to stabilize results, all the way to outright personal gain and artificial manipulation or distorted by psychological excesses, as Graham and Dodd called it. The analyst must question the why. You might be thinking, this sounds like a lot of detective work, and it is, but it's essential because, as Graham and Dodd emphasized, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. While a fleeting spike in earnings might excite the market, true business health comes from a predictable, recurring stream of income. Failing to scrutinize these details prevents investors from truly understanding a business's health, leading to decisions based on illusion rather than fact. Therefore, a careful analyst will always question the motivations behind a company's accounting practices, especially when they deviate from standard, transparent reporting. The bottom line: the income statement is often a story, not just a set of facts. If you want to write your own success story, subscribe so you don't miss our next deep dive into corporate reporting. 4. The ultimate reality check. Welcome back to Audiobook Bites, where we distill timeless wisdom from the giants of finance. Today, we're plunging into a chapter that Benjamin Graham and David Dodd considered the ultimate reality check for any investor: deconstructing the balance sheet. In the chaotic carnival of the stock market, where emotions often run wild and prices can swing like a pendulum, it's easy to get lost in the noise. We often hear about a company's soaring earnings or impressive revenue growth, captivating headlines that pull us in. But here's the catch: the income statement, for all its drama, tells a story over time. It's a narrative, and like any good story, it can be manipulated, embellished, or even entirely fabricated to paint a picture far rosier than reality. This is where the balance sheet steps in. Unlike the fluid, ever-changing income statement, the balance sheet is a static portrait. It's a snapshot, a precise accounting of a company's financial reality at a single moment. Graham and Dodd championed its use as the most reliable financial statement precisely because it reveals the bedrock of a company's existence: its actual resources, its true financial condition, and the solid or shaky ground of its capitalization structure. You might be thinking, a balance sheet? Sounds dry. But trust me, this is where the real detective work begins. It's where you uncover the hidden truths, the secret strengths, and the silent dangers that earnings reports often obscure. Graham and Dodd insisted on analyzing the balance sheet for what they called intrinsic value. This isn't some vague, feel-good number. As they put it, intrinsic value is that value which is justified by the facts, e.g. the assets, earnings, dividends, definite prospects, as distinct, let us say, from market quotations established by artificial manipulation or distorted by psychological excesses. The balance sheet is central to uncovering these fundamental facts. First, let's talk about working capital and asset values. The balance sheet tells you how much capital is genuinely invested in the business. It details the current assets, cash, receivables, inventory, and subtracts all liabilities ahead of the common stock. This calculation provides an investor with a crucial current asset value, or even a cash asset value. Graham and Dodd observed that many companies, particularly during depressions, traded below their liquidation value. Imagine buying a business for less than the cash in its register, plus getting its inventory and equipment for free. This wasn't merely a bargain. It was a screaming opportunity that the market, driven by panic, utterly missed. A strong working capital position means a company can weather storms, pay its debts, and even fund growth without external borrowing. A weak one, conversely, signals deep trouble, regardless of what the income statement might boast. But what about potential hidden liabilities or overstated assets? This is where the balance sheet becomes your ultimate truth serum. Remember the infamous WorldCom scandal? Before its colossal bankruptcy filing in 2002, the company's market value soared, fueled by seemingly impressive earnings growth. But a thorough look at the balance sheet would have raised immediate red flags. Assets were fraudulently inflated, and debt was piling up. What management presented as investments were, in reality, operating expenses disguised. The balance sheet, if carefully scrutinized, would have screamed, danger. It's far harder to manipulate a snapshot of existing assets and liabilities than it is to weave a narrative of income and expenses over a period. Therefore, any investor who paid attention to the balance sheet would have seen enough to avoid both its stock and bonds, as they offered no real safety of principle or promise of a satisfactory return. Finally, the balance sheet provides a vital cross-verification for reported earnings. When you compare a company's balance sheets over several periods, you can see if reported profits actually translate into growing assets or a stronger financial position. If a company claims consistent profits but its cash assets are dwindling, or its debt is ballooning, that's a telltale sign of accounting artifices. Graham and Dodd noted that some companies would manufacture earnings by charging expenses directly to surplus, boosting reported income. But the balance sheet doesn't lie. It shows the true impact on the company's financial health. It's the constant tension between the stories told by the income statement and the hard facts presented by the balance sheet that makes disciplined analysis so powerful. The bottom line: the balance sheet is the anchor of sound investment. It provides an unvarnished view of a company's true worth, revealing what is, rather than what is merely hoped for. 5. Trusting averages, not trends. Welcome back to Audiobook Bites, where we distill timeless wisdom from financial classics. Today, we delve into a crucial lesson from Benjamin Graham and David Dodd's security analysis. The illusion of forecasting, trusting averages, not trends. It's a seductive idea, isn't it? The dream of predicting the market's next move, catching the wave just as it crests, and sidestepping every crash. Wall Street, with its dazzling screens and breathless commentators, constantly whispers promises of future gains, often tied to a company's latest hot trend. But Graham and Dodd pull us back to earth, warning against what they call the delusion and the nemesis of the world of finance, an overemphasis on the superficial and temporary. They argue that trying to forecast short-term market movements or projecting earnings trends indefinitely is a speculative gamble, not sound investing. You might be thinking, but don't companies grow? Isn't a rising earnings trend a good sign? And it is to a point. But economic forces like competition and diminishing returns are relentless. They act like gravity, eventually flattening even the most impressive growth curves. Therefore, betting solely on an upward trend without understanding the underlying stability of the business is a precarious strategy. Consider a company whose earnings have soared for 3 consecutive years. A speculator might draw a straight line, confidently predicting an unending ascent. But Graham and Dodd would caution that this is like assuming a .300 hitter will never strike out. The market, they tell us, is far from a precise instrument. Rather should we say that the market is a voting machine, whereon countless individuals register choices which are the product partly of reason and partly of emotion. Those choices, fueled by transient optimism or sudden panic, lead to exaggerated prices disconnected from reality. Instead of chasing these fleeting trends, Graham and Dodd advocate for a more grounded approach, relying on long-term historical averages. They suggest that what a company has consistently demonstrated its ability to earn over many years provides a far more dependable guide than a recent, possibly anomalous surge. This is particularly true for businesses with inherent stability, companies operating in industries with predictable demand, strong competitive advantages, and consistent profitability. For these stalwarts, their long-term average earnings act as a truer compass than the volatile needle of recent quarters. The market's tendency to overvalue growth at any price often means overlooking solid, stable businesses selling at a bargain. These are the companies where true investment opportunities hide. Graham and Dodd define intrinsic value. Is that value which is justified by the facts, e.g. the assets, earnings, dividends, definite prospects, as distinct, let us say, from market quotations established by artificial manipulation or distorted by psychological excesses. This means looking beyond the hype and focusing on the tangible, enduring qualities of a business. Imagine 2 companies. One is a high-flying tech startup with soaring but erratic earnings, priced at 50 times its meager profits. The other is a well-established, somewhat boring utility company with stable, though slower, growth, trading at 10 times its consistent average earnings. The market, in a moment of euphoria, might bid up the tech stock to astronomical levels based on a projected trend. But it gets worse. When that trend inevitably falters, the market, like a fickle crowd, abandons it, sending the price crashing. The utility, however, with its steady earnings and robust balance sheet, weathers the storm. Therefore, focusing on the certainty of averages for stable businesses, rather than the allure of trends in volatile ones, provides a crucial margin of safety. The bottom line: true investment wisdom lies not in the futile attempt to predict the future, but in a disciplined reliance on demonstrable, historical averages and a deep understanding of a business's inherent stability. The future, for Graham and Dodd, is primarily a hazard to guard against, not a source of vindication for overly optimistic forecasts. 6. Beyond the illusion of safety. When you hear the word bond, what comes to mind? Safety, stability, a bedrock for your wealth? That's the illusion Benjamin Graham and David Dodd desperately wanted to shatter. They understood that the very form of a bond, that seemingly ironclad legal promise, often seduces investors into a false sense of security. They argue vehemently that true safety in fixed-value investments, whether bonds or preferred stocks, doesn't reside in the legal lien it holds or a tempting high coupon rate. Imagine a beautifully wrapped box, promising untold riches. The label might say safe, but what's inside? A distressed company's bond, for example, might offer a juicy yield, but if the business is teetering on the edge of collapse, that high yield isn't a reward for taking on more risk. It's a glaring symptom of it. Graham and Dodd famously asserted, risk and yield are incommensurable. You cannot simply compensate for deficient safety by accepting a higher return. It often means you're just trading a smaller, assured loss for a larger, more probable one. So, where does true safety lie? For Graham and Dodd, it's found in the issuer's ability to pay. This demands a thorough analysis of the company's financial strength, especially when economic winds turn cold. Here's the twist. It's a negative art of bond selection. Instead of hunting for the perfect bond, your primary task is to systematically exclude the weak ones. Picture yourself inspecting a vast orchard. You're not searching for the single brightest apple. You're meticulously discarding every bruised, worm-eaten, or rotten one. What remains is your curated universe of acceptable choices. You might be thinking, but surely an investment grade label from a trusted rating agency protects me? But Graham and Dodd caution that blindly trusting such external validations is a dangerous path. They recognize that these investment-grade designations alone do not guarantee safety, especially when underlying conditions shift. Their principle cuts through the noise. The safety must be assured, or at least strongly indicated, by the application of definite and well-established standards. This means conducting deep dives into the issuer's consistent earning power, its tangible asset values, and crucially, the inherent stability of that business, not just a fleeting snapshot of its current performance. Consider the subprime mortgage crisis of 2008. Many securities, once stamped AAA by rating agencies, tumbled into junk status overnight. Investors who relied solely on those prestigious labels, but failed to conduct a thorough analysis of the underlying financial strength and the true ability to pay of the borrowers, suffered immense, often total losses. Therefore, the timeless wisdom is clear. Always look beyond the illusion of the label. Always ask, can this issuer really meet its obligations, even if the world turns upside down? The bottom line, for fixed value investments, true security isn't a given. It's diligently earned through profound insight, disciplined exclusion, and an unshakable focus on fundamental strength. 7. Finding bargains in the ruins. In the tumultuous world of finance, moments of crisis often present the most profound opportunities. Benjamin Graham and David Dodd, the architects of value investing, observed that in times of financial distress, the market behaves less like a precise weighing machine and more like an emotional voting machine. During these periods of widespread panic and uncertainty, security prices can plummet far below their inherent worth, creating veritable gold mines for the disciplined investor. The core of distressed investing lies in this very market irrationality. When a company teeters on the brink of bankruptcy, or even plunges into it, most investors flee in terror. But for those who heed Graham and Dodd's wisdom, these moments are not signals for retreat but for diligent analysis. They illuminate how to uncover fallen angels. Companies with solid underlying assets or enduring earning power, temporarily obscured by calamity. To succeed in this unique arena, you first need to learn to analyze companies facing bankruptcy or near bankruptcy for their true underlying asset value. This isn't about forecasting short-term earnings, which become irrelevant when the lights are about to go out. It's about meticulously dissecting balance sheets, valuing physical assets, and understanding what could be salvaged or restructured. Here's the catch. These situations are rarely straightforward. you'll need to grasp the legal and financial complexities of reorganizations and liquidations. Are the creditors getting cash or a grab bag of new, often illiquid securities? What are the senior claims, and what rights do equity holders retain? A thorough understanding of legal priorities and the potential outcomes of a restructuring plan is paramount. For example, a bondholder's claim on assets, while legally senior, might involve complex and lengthy legal proceedings that deter many. But a disciplined investor, willing to do the hard work, can find clarity amidst this chaos. This brings us to the discipline required. Most people sell when fear reigns. Therefore, the opportunity to buy distressed securities often arises precisely because others are selling due to fear and uncertainty, pushing prices to absurdly low levels. Graham and Dodd famously said, "Precision is in any case unnecessary because the aim is to pay a good deal less than intrinsic value, so as to provide a margin of safety. This margin of safety is your ultimate protection, allowing for errors in judgment and buffering against further declines." You might be thinking, this sounds incredibly complicated, but that's the point. The complexity and the prevailing sentiment create the discrepancies. It's when everyone else is overwhelmed, when the market's voting machine is at its most emotional, that diligent research into the facts, the assets, the legal rights, the true intrinsic value, yields the greatest rewards. The bottom line, as Graham and Dodd instructed, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Distressed investing, when approached with rigorous analysis and emotional fortitude, offers a path to safety and satisfactory returns by buying assets others mistakenly deem worthless. If you're ready to master these powerful concepts and uncover hidden opportunities, subscribe to Audiobook Bites to ensure you don't miss our next deep dive into financial wisdom. 8. The power of informed ownership. Welcome back to Audiobook Bites, where we distill the wisdom of investment classics. Today, we're diving into a crucial, yet often overlooked, aspect of security analysis by Benjamin Graham and David Dodd: the dynamic, or often dysfunctional relationship between shareholders and management. Graham and Dodd famously called the typical American stockholder the most docile and apathetic animal in captivity. It's a harsh label, but one that rings with timeless truth. This apathy isn't just about missing quarterly calls. It's about surrendering control, allowing managements to operate unchecked, often at the expense of those who actually own the company. First, let's talk about the money, management compensation, and how capital is allocated. You might think, well, they're the experts, they know what's best. But here's the catch. When executives set their own salaries, award themselves massive bonuses, or issue stock options without proper shareholder oversight, their personal interests can diverge wildly from yours. Graham and Dodd observed that management frequently prioritizes personal aggrandizement and empire building through unwise expansion, rather than maximizing long-term shareholder value. Picture a company with ample cash, but instead of returning it to owners or investing wisely, it's used for vanity projects or inflated executive perks. The critical role of informed ownership here becomes glaringly obvious. Now, consider dividend policies and share repurchases. Traditionally, dividends were a clear signal of a company's health and commitment to its owners. But it gets worse. When management decides to withhold substantial earnings, not for necessary reinvestment, but simply to accumulate excessive surplus under their control, it creates a paradox. They claim it benefits the company. But for whom? Graham and Dodd would argue that these retained earnings often lose their effective value for stockholders if not deployed wisely or distributed. Therefore, an intelligent investor must question whether retained profits truly serve the owners or merely empower the managers. Similarly, share buybacks, while potentially value-enhancing at attractive prices, can become self-serving if executed at inflated levels, effectively destroying shareholder capital to prop up stock prices or facilitate option exercises. This brings us to the need for relentless transparency and accountability. Graham and Dodd were pioneers in advocating for full disclosure, especially concerning what management does with the company's money. They insisted that all corporate policies affecting the security owner, from capitalization setup to dividend policy and managerial compensation, be subject to scrutiny. If management is withholding crucial information, or if their actions consistently dilute shareholder value, it is not merely a matter of bad luck. It's a symptom of a deeper misalignment. The bottom line: an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. As active owners, we must demand this thorough analysis, transforming ourselves from docile animals into vigilant stewards of our wealth. If you want more insights into building a truly resilient investment portfolio and avoiding the pitfalls of corporate apathy, subscribe to Audiobook Bites so you don't miss our next deep dive into timeless financial wisdom. 9. Expanding the circle of competence. Graham and Dodd wrote in a world where investing meant looking across the street, not across oceans. Yet, their foundational principles, honed in the crucible of the Great Depression, were so robust, so inherently true, that they transcend geography and time. We're talking about applying value investing to global markets, expanding your circle of competence far beyond familiar shores. Now, you might think that foreign markets introduce insurmountable complexities. And it's true, they do. Diverse accounting standards, varied corporate governance, currency fluctuations, and even language barriers can seem daunting. But here's the catch. These very complexities often create a Graham and Dodd's heaven, less efficient markets ripe for disciplined value investors. Take accounting standards, for instance. Early in my career, American investors would often ask, "Can you really trust foreign company accounting?" My answer was always, "Compared to what?" While our own standards have faced debacles like Enron and WorldCom, many foreign accounting practices, though different, can be even more conservative. Imagine the Dutch brewer Heineken in the late 1980s. On paper, it looked less profitable than its US counterparts. But once we adjusted its numbers from replacement cost accounting to generally accepted accounting principles, Heineken's true profitability shined through. Therefore, fundamental analysis, adapted for local nuances, is paramount. Currency risk is another factor. Some investors try to hedge every foreign currency exposure back to US dollars. But I believe a more robust approach is diversification. You see, the very thing that often makes a foreign stock cheap, a reeling local currency, can also be its future catalyst. When the currency recovers, your investment gets a double boost. It's about not getting caught up in short-term noise. And then there's management. In foreign markets, where corporate governance rules can be less stringent than in the US, finding owner-minded management is even more critical. These are the leaders who prioritize the long-term protection and enhancement of their business franchises, resisting the urge to funnel assets away from shareholders. But it gets worse. Cultural and language differences can make direct contact challenging. Therefore, a long-term track record of sound decisions and a focus on simple, strong businesses become your most reliable indicators. As the masters themselves taught, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. This applies whether you're investing in New York or Norway. The beauty of value investing is its universality. Whether domestic or global, the core principle remains. Find something worth more than its price. Foreign markets, often less scoured for bargains, present a wider universe for those willing to do the rigorous work. The bottom line: precision is in any case unnecessary because the aim is to pay a good deal less than intrinsic value, so as to provide a margin of safety. If you want to continue honing your investment insights and stay ahead in this ever-changing global landscape, be sure to follow Audiobook Bites so you don't miss our next deep dive into timeless financial wisdom. 10. A call for discipline and patience. Graham and Dodd's security analysis remains a beacon for intelligent investors. It champions discipline over emotion. True wealth, they teach, isn't built by fleeting trends, but by painstaking analysis, demanding a margin of safety and unwavering patience. This path, though slow, ensures capital growth and peace of mind, allowing you to get rich slowly. First, commit to continuous learning and rigorous fundamental analysis. Think of investing as becoming a master financial chef. Meticulously study each business, understanding its true intrinsic worth. Graham and Dodd demand thorough analysis, sifting through facts. You might be thinking, but markets move so fast. Still, understanding a business's intrinsic value remains constant. Next, cultivate patience and emotional resilience against market volatility. The market, Graham famously observed, is not a weighing machine. It's a voting machine whereon countless individuals register choices which are the product partly of reason and partly of emotion. It swings wildly. Here's the catch. Most people seek quick profits. But to succeed, you need emotional resilience to stand apart. Imagine everyone rushing a hot stock, fueled by euphoria. You, armed with analysis, see its price exceeds true worth. That takes immense patience. But it gets worse. When those stocks crash, holding what you know is undervalued, waiting for sanity, is intense. Therefore, inner calm is as vital as any spreadsheet. This leads to contrarian action. Buying when fearful, selling when greedy. The market always offers price-value discrepancies, wildly mispriced securities. But to seize these, you must act against prevailing sentiment. Therefore, the discipline is to buy when fear grips the market and sell when greed pushes prices beyond rational measure. Remember, precision is in any case unnecessary because the aim is to pay a good deal less than intrinsic value so as to provide a margin of safety. This wisdom is not for the get-rich-quick speculator, nor those relying on gut feelings. It's not for those unwilling to dive deep into fundamentals or who lack patience. The safety must be assured, or at least strongly indicated, by the application of definite and well-established standards. The bottom line, Graham and Dodd's security analysis provides a rigorous framework for building enduring capital and profound peace of mind. If you want more such insights and to stay disciplined, subscribe to Audiobook Bites so you don't miss our deep dives into the classics that empower you to think like the masters.